Welcome back, everyone. And, the conference has talked around too big to fail almost in every session. So now we're going to focus in a little bit more deeply on it. And of course, this is sort of like, I guess Dick Herring said yesterday that the reason for Dodd-Frank was to solve the too big to fail problem. So this session is, we're going to ask the question, well, have we solved it? If we have solved it, great. If we haven't solved it, what else can be done? And are there any activities that regulators are doing or part of the law that actually make things worse than better? Of course, this is a quintessential time inconsistency problem, right? We have a regime where, everything is supposed to work, but then as soon as you get into the point where the regulators have to step in or the supervisors and have to make policy decision, right? The question is, will they bail out an institution and try to prevent, the outcome of a systemic failure, or do they let the firms fail and then, or do they let the firms fail and then have that kind of problem? So, I think Franklin talked about this morning in terms of, how do you make that decision, and perhaps, doing less may be better than doing more, and we've talked about that in a number of other cases. So it seems like the one part of this, which was in a session earlier, was about the resolution of these failed banks. If the regulators don't feel comfortable in letting the institutions fail, then we haven't solved too big to fail. So this session has, people that probably need no introduction. Their bios are in your book. Each will bring a lot of insights into what's, I think, one of the deep questions. And they'll talk about incentives and other things that will be indicators of how big the too big to fail problem still is, and what can be done about it. So we're going to go in a little bit different order than is in your booklet. Professor Kaufman is going to start us off because he's going to be talking about definitional things that then will set up the rest of the conference. So without further ado, George, take it away.
Thank you, Loretta. What I'm going to talk about is that definitions matter. Too big to fail is a fuzzy concept. We use it all the time. I'll show you that people mean different things when they talk about it, and part of the controversy about too big to fail is because of differences in definition. Below are some of the terms that have been used to describe too big to fail: too complex to fail, too important to fail. You've heard these many times. The last two, too big to prosecute, that's come up recently from New York State, where the accusations was that the regulators were too reluctant to prosecute the big banks because they were large, big, important people in the community. Too big to sink is the beginning of a talk of developing for the future, which deals with Moby Dick, and that too big to fail is the whale that I've been chasing for a long time. I'm going to focus on the confusion between two concepts, rescue and resolution. And the confusion, I think, appeared earlier today, and it's one that is quite common. Rescue is the firm is alive. It is not allowed to fail. Too big to fail. These firms are not permitted to fail. Explicit injection by the government, explicit or implicit injection by the government of capital sufficient to maintain positive net worth means there are no losses to unsecured creditors, keep troubled firms alive, maintain the critical services. The old shareholders are either totally wiped out or partially wiped out. An example of that is TARP. Resolution, on the other hand, deals with dead firms. The firm was permitted to fail. That is strictly not too big to fail. It did fail. It's a question then of allocation of the losses of the dead firm. As net worth is negative, it generally involves losses to unsecured creditors, unless the creditors are bailed out after death. When is it a rescue? When is it a resolution? Let me just give you two quotes. The first one is from the Financial Stability Board. It says the too big to fail TBTF problem here we go. The too big to fail problem arises when the threatened failure, looking into the future, of a CFI leaves public authority with no option but to bail it out. So this is ex ante. using public funds to avoid financial instability and economic damage. The CFI framework sets out recommendations for improving the authority's ability to resolve such institutions in an orderly manner without exposing taxpayers to loss while maintaining continuity of their vital economic functions. This may require changes to resolution regime. So the first sentence deals with rescue, the second sentence deals with resolution. We don't have to go that far. Let me go to Deniz next. And at the bottom there, we have a quote from Deniz's paper. The too big to fail doctrine postulates that the government will not allow large financial institutions to fail if their failure would cause significant disruptions to the financial system and economic activity. It is commonly claimed that because of the TBTF doctrine, large financial institutions and their investors expect the government to back the debts of these institutions should they account for national difficulty. If you don't allow the bank to fail, you needn't bank the debts. The debts are only backed if the firm fails. So you have a difference of ideas, and the resolution is one thing, rescue is something else. I think we'll find that most of the people are talking about rescue rather than resolution. Does it matter? Yes, it does for a number of reasons. One, when we talk about too big to fail legislation, we talk about the dead firms, the resolution in fiducia, the systemic risk exemption to least cause resolution, and the resolution in Dodd-Frank, the orderly liquidation authority, both deal with dead firms. And it's also important, as we'll see, for the control variables in the empirical results. The liability mix becomes very important. You have a differentiation not only by legal priority, but you have it by similar situated creditors. Legally, that differential can be made. Oops, I didn't push that button. Thank you. That difference, similarly legally situated for creditors, can be differentiated by the FDIC by rulemaking, so that the FDIC, in paying off its creditors or dealing with them in the resolution, is not limited under certain circumstances by the legal priority. In this paper, we only deal with the dead firms, only deal with resolution. Let me give you a definition that I use of too big to fail, that it generally refers to a resolution regime in which the government intervenes and does not resolve selected dead firms by the process usually applied to other insolvent firms in the same industry, such as bankruptcy, with respect to loss allocation. So you take the firm out of the general resolution process with a bank holding company or with a large non-financial SIFIs, non-large financial SIFIs. You take them out of the bankruptcy process and bring them under the ordinary, orderly liquidation authority. And with banks, you take them out of least systemic risk exemption, least cause resolution, and you take them out of the least cause resolution. Some creditors and others in the money shareholders will receive more than they would under the usual resolution process. So when you take them out of the usual resolution process, where they would have taken losses, under the special resolution process, they do not necessarily take these losses. They'll be partially or fully protected. The difference between the amount paid to the creditor at resolution and the corresponding pro rata recovery amount is the loss, is the protection or bailout funded by a third party. So the loss has to be funded by somebody if you're going to bail them out. What is the reason for too big to fail? Is because the failure of these institutions with losses to the uninsured creditors would cause disproportionately large collateral spillover externality damage to the firm's economic area and beyond to the usual bankruptcy, if the usual bankruptcy losses were applied to pro rata to some or all of the insolvent firms in the money counterparties. So if there are losses to these counterparties, you're afraid that the externality, the spillover damage, is just too great. So you want to protect against that. This was said probably a lot better than I've said by Bill Dudley, president of the New York Fed, and you're all familiar with these arguments, so I won't spend much time going over there. But there is a cost to the too big to fail policies, and that this has become now a major policy issue as the costs have become high. What are the costs? Well, we're familiar with most of them. Moral hazard, which leads to reduced market discipline and excessive risk-taking. We've talked about that today, and you all know that. Also, the lower cost of funds, which is a subsidy, which leads to unfair competition, inefficient allocation. What hasn't been brought up today and is frequently overlooked is political interference. That when you have too big to fail, who decides what is too big is the regulators and the politicians, and this frequently has gone down to banks as small as $2 billion. So political intervention is a very important cost of too big to fail. What are the extreme too big to fail resolution definitions? On the one end, you have no special too big to fail resolution. In other words, you use the bankruptcy code. Too big to fail has a zero protection. There is no protection. On the other extreme, it's a special resolution regime. It fully protects all in-the-money counterparties, except possibly shareholders, and you have 100% too big to fail. Here, the government is the third party, purchases the assets at par value, and assumes all deposits and other liabilities. And this also then means you not only have the two extreme definitions, you have a range of in-between definitions. And how do you determine the in-between definitions? You can do so by the insolvent firm's depositors, counterparties fully or partially protected. Who are they and to what extent? Or you can have the third party that funds the protection, the government, which is the taxpayer, or the private firms in the industry, which is Dodd-Frank and Fiducia require, or the FDIC, and I put a question mark after the FDIC, because the bankers like to argue this is their funds, and other people argue, no, this is really the FDIC, the government's funds, and so we don't know exactly which it is. The range of too big to fail resolutions now then go from 0 to 100%. And it's useful to have agreed upon definitions of too big to fail. I'll give you 3 examples of definitions that are uncertain as to where it fits on the too big to fail scale that I just showed. Let me give you the first one. This, in a no too big to fail resolution, quote, shareholders are wiped out. The CEO is fired, and the institution no longer exists, and the regulators may, at that point, the FDIC, pay off some debts if it is necessary to prevent a downward spiral, but any penny paid out is recouped from the large financial institution. In other words, here you are protecting those counterparties, where if you don't protect them, you would have a downward spiral. Many people would say this is too big to fail because we are protecting part of the counterparties. Where did I get that quote from? Our friend Barney Frank. So he's ending too big to fail, has a definition, which many of us would say isn't too big to fail. Definition. Let me give you another example here. A reform intended to ensure that no firm is too big to fail was the creation by Dodd-Frank of orderly liquidation authority. Under this authority, the FDIC can impose losses on a failed institution shareholders and creditors while avoiding runs by short-term counterparties. Obviously, the only way you could avoid a run by a short-term counterparty is to protect the counterparty against losses. For the resolution mechanism to be credible ex ante and effective ex post, the capital and liability structure of major firms must be able to absorb losses without either threatening short-term funding liabilities, again, that means they're protected, or necessitating injections of capital from the government. This again, excuse me?
You have 5 more minutes.
Okay. Again, this is a definition that many of us would say is too big to fail. This statement comes from Cirillo. Let me give you one more definition that is being used. The source of funds for a bailout is not the real issue, and somebody argued that yesterday. The possibility of a creditor bailout creates moral hazard, no matter where the bailout funds originate, and it is the moral hazard that provides the largest banks or other large financial firms with competitive advantage. So you have three definitions that many of us would say are too big to fail, yet you have strong proponents argue this is not too big to fail. This is a regular resolution process. Alternative definitions, they basically come down to whether the social benefits are greater than the social cost, and they view it as not too big to fail. It's only when the social costs are greater than the benefits that they view these resolutions as too big to fail. Which counterparty should be protected? Again, you protect the counterparties. These people would argue for where the net social welfare increases. The benefits are greater than the costs. What are the benefits? We talked a great deal about the cost. The benefits are, one, obviously reduction in the estimated collateral value if no protection is provided. And secondly, the political short-term safety or cover for the regulators. And we overlook that argument quite frequently, that the regulators are protected if they bail out the counterparty in the short run. Many of these benefits, especially, are highly subjective, measuring the cost of the benefits, and are likely to vary greatly among the policymakers. And thus, the protection of the same creditors may be viewed as representing different degree of, of too big to fail resolution. So that there's uncertainty, and you'd have the same bailout of the same creditors viewed differently by the different policymakers. Fiducia and the Dodd-Frank Act give the FDIC as a receiver authority to differentiate among creditors with the same legal liquidity priority. That's very unusual. The FDIC has promulgated as a rule that potentially protection is limited only to senior unsecured in-the-money creditors with maturities of less than 360 days. So here you have something that says legally they have the same priority, but the law gives the FDIC the ability to differentiate between the same legal priority, and the FDIC has done so for Dodd-Frank, saying that only if you have an unsecured credit of less than 360 days will there be a possibility of protection. The rationale appears to reduce runs from large institutions to maintain critical services. Thus, the FDIC does not appear to perceive resolutions in which demand deposits are protected as too big to fail. The protection is in, quote, the public interest. This slide deals with really that there have been numerous attempts to kill too big to fail. They've all failed. Like trying to kill a vampire, and you got to stick a gold cross into the heart of the vampire numerous times, and they've been unsuccessful. As I said earlier, I'm going to change my image from vampires to Moby Dick, to chasing the great white whale and seeing if you could sink him. You know what happened to the captain in Great White in Moby Dick? He's at the bottom of the ocean, and the white whale is still swimming. I want to thank you at this point and say this in my presentation, but Jalapa has asked us to deal with some particular questions, so let me deal with those in the last 30 seconds I have. Will Dodd-Frank end too big to fail? Technically, yes, for non-bank financials. But the FDIC may protect uninsured deposit creditors only if doing so reduces the loss to the FDIC. So they can only protect creditors, unsecured creditors, if the loss to the FDIC in the resolution is reduced. But for banks, fiducia also permits protection of unsecured counterparties, not only if it reduces the loss to the FDIC, but if it reduces the threat to financial stability. This is a major difference, and Sheila Bair fought for this very hard in the legislation, and she, at least she tells me, that they came very close to losing this, and this to her is very important. So that the regulators the FDIC can now only protect uninsured creditors if the protecting will reduce the resolution cost to the FDIC. No longer can they use the excuse that it threatens financial stability. Now, you know, that's the letter of the law. Practically, I don't think it makes much of a difference because there's a tremendous agency problem here. You can interpret these words any way you want. In Dodd-Frank, you take the action. The appeal can only be made within 24 hours. It's already done, and it's very difficult to undo what you've done. And how have recent regulations improved or worsened the too big to fail problems? I don't think they've done anything. There's neither. What needs to be done to end too big to fail? It's quite clear in my mind. Randy's heard this before when I was discussing in one of his papers a couple of years ago at Harvard. You've got to solve the agency problem. And how do you solve the agency problem? That's exceedingly difficult. I remember during the discussion leading up to the Dodd-Frank Act, I had a phone call from one of the staff members on the Senate Banking Committee, and we talked about the agency problem. I said, well, maybe public hanging. Waited for a second, said, no, China's tried that and it doesn't work either. Would the Dodd-Frank Act living will do it? It's in the right direction, but it doesn't eliminate the agency problem. How does one make the market believe? You got to let some large financial firm fail with actual losses to unsecured creditors. The creditors must walk the walk as well as talk the talk. Thank you.
Thanks, Rich. Deniz, you're up.
Thank you.
So Deniz is going to tell us why we can't rely on market discipline yet until we solve this too big to fail problem.
Right. Well, thank you very much for the invitation and giving me the opportunity to present this paper. It's joint work with Viola Chai and Joe Warburton, and the standard disclaimers apply. This paper doesn't reflect the views of the World Bank. So, as the title suggests, what we try to do in this paper is empirically examine investors' expectations of potential government support to large financial institutions. So, as you all know, this is a so-called too big to fail problem, whereby if a large financial institution gets into trouble, there's this expectation by market participants that the government will step in and shield them from potential losses. So this has two effects, right? First, it will provide some sort of funding advantage to these large financial institutions, and it will also provide distortions in the market, in the pricing of risk. So if investors are shielded from losses, they're not going to be pricing in the risk correctly. And this is important because, as Dr. Kroszner mentioned in his opening remarks, regulators might actually rely on some of these market-based measures to assess risk. So it's important that they reflect true risk. And what we do in this paper is look at the corporate bond market and see both the pricing implications of this implicit guarantee and how it distorts market prices. So although intuitively it seems like there should be this implicit guarantee and that it should be priced in the markets, it's not entirely clear how this works in practice. So if you look at the actions of the U.S. government, historically they seem to have taken a somewhat random approach to intervention. So they have bailed out some firms, let others fail, they arrange private bailout for others, and so on. So if you look at the most recent crisis, AIG and Bear Stearns were bailed out, but not Lehman Brothers. And the government also has this policy of constructive ambiguity that Richard was talking about yesterday to sort of reinforce this uncertainty. So it's not entirely clear which direction this should go. As a result, there have been a lot of discussions on this topic, lots of conferences, lots of seminars. I attended several now. Bernanke recently said that there is a subsidy. It's coming because of market expectations that the government would bail out these firms if they failed and that we should get rid of it. There has been some pushback from the industry. There have been some industry reports sort of questioning the subsidy, whether it's there, how big it is, and so on. American Bankers Association, for instance, they questioned the existence of a too big to fail subsidy. They said that the markets may even be imposing a funding penalty on large banking institutions. So obviously this is a very important question. As a result, the U.S. Senate asked the GAO recently to sort of look into this, and I think they have some initial results now. So our contribution is that we're going to be looking at the pricing impact in the corporate bond market. So obviously we're not the only ones who have looked at this issue before. There's a big literature, and I won't go through this in detail, but after the SNL crisis, after the passage of fiducia, there have been a number of papers looking at how subordinated debt of bank holding companies respond to changes in risk. So although there's been a lot of research in that area, they don't really make a distinction between large versus smaller banks, which we do in this paper. There have been other papers looking at this within the European context. There have been some papers examining the pricing in the equity markets, although you would think that this implicit guarantee would be more important in the debt markets than in equity markets. Historically, equity holders have suffered a whole lot more than debt holders. So there have been some papers looking at M&A activity and its impact on bond prices as well. Hailuk has a paper, for instance, whereby he shows that if two small banks merge and reach a certain threshold, their buying yields sort of go down. So what are the key questions that we're looking at? The first is, do investors expect government support? And how does this affect pricing of risk? We also look at the impact Dodd-Frank and FDIC SPOE program had on ending too big to fail expectations. So what we find is that bondholders do indeed expect public support. And it is priced in the markets. In the corporate debt market, we find that on average about 20 to 30 basis cost funding advantage to the large financial institutions. And it reached as high as 100 basis points during the crisis. We also find that when we do an event study that some of these more recent regulations did not completely eliminate expectation of government support. So just to give you an idea of where I'm going with this, so if you were to look at the relationship between size and corporate bond spread, so this is the yield publicly traded debt of a bank minus the treasury match yield, you see a very strong negative relationship. So if you look at the relationship between size and risk, and we're using Merton's distance to default measure here to proxy for risk, you don't see much of a relationship. So although it appears that larger institutions definitely have a lower spread, it's not necessarily because they are less risky. So definitions are important, as George mentioned. So what we want to capture is really systemic importance, right, with too big to fail. And it's a broad concept. It's supposed to capture a lot of things: interconnectedness, global footprint, number of markets a bank operates in, opacity, and so on. So we use size as our main measure of too big to fail. And the reason for this is size tends to be highly correlated with things like interconnectedness, complexity, and so on. So we're going to be looking at size. We're going to be looking more closely at the right-hand side of the distribution. So we create this variable size 90, a dummy variable that takes on a value of 1 if a bank is in the highest 90th percentile in terms of size. We also look at the top 10 banks. We also use other measures of systemic importance, such as COVAR and S-risk. Okay, so if we collect yields, the data goes back to 1990. We collect data from a couple of different data sets. In the sample, we include all financial firms, not just banks. And the reason that we did this is we did not want to exclude companies like AIG, GE Capital, which are obviously very systemically important, even though they're not classified as banks. Okay, so we have spread on the left-hand side, okay, and we're running that against a number of controls at the issue level. So we control for things like time to maturity, seniority of the bond. Then we have a number of bank level controls. So we control for leverage, ROA, some macro controls such as the default spread, term spread, and so on. And as I mentioned, our main measure of risk is Merton's distance to default measure. And this is a market-based measure which tells you how many standard deviations you are from the default boundary. So the further away you are, obviously lower the risk and lower the spread. Okay? So if we throw in size into this regression, we find, again, a very strong negative relationship. Bigger the size, lower the spread. Same thing, we find similar results if you control for firm fixed effects. So if you control for fixed firm heterogeneity over time. So looking at the right-hand side of the distribution, concentrating on the very large banks, we find a similar result. So For the size 90 variable, again, this is a dummy variable that takes on a value of 1 if the bank is very large. Okay, it's at the 90th percentile of the size distribution. We find that on average, over the full sample period we're looking at, there's a funding cost advantage of about 32 basis points. Okay, and this is really concentrated at the very top. So you don't see this effect when you look at the 60th or the 30th percentile. Find a similar result if you look at the top 10 banks, it's about 33 basis points. And if you use these alternative measures of systemic risk, such as COVAR and S-risk, and the results are very similar. We also looked at some cross-sectional differences, whether there's a difference between deposit-taking institutions versus insurance companies and brokers and dealers. And this cost funding advantage is highest for banks. Okay. We also control for non-financial. So we use them as a control when we're computing the subsidy. So we look at the difference between large financials minus small financials, large corporates minus small corporates, and then look at the difference between the two. Okay. So once you control for the corporates, again, you find a similar number. It's about 36 basis points. Okay, so the next thing that we want to look at is whether there's distortion, the distortion in the pricing of risk. Okay, so as I mentioned before, the further away you're from the default boundary, lower the risk, lower the spread. But when we interact the business default measure with the size 90 variable, it's positive. So the sensitivity of spreads to risk goes down, okay, for very large banks. So this relationship sort of breaks down for very large financial institutions. And we might be underestimating risk, since Merton's distance to default measure is a market-based measure if the implicit guarantee is also priced in the equity markets. So if you use an accounting-based measure such as the Z-score, again, you find similar results. Same thing if we use volatility. As before, we use corporates as a control. So we're looking at the sensitivity of large corporates, comparing them to the sensitivity of large financials. So once you do that, there are a lot of interaction terms here, but you find a similar results. Okay. So the sensitivity of spreads to risk is much higher for corporates compared to large corporates, rather, compared to large financials. We also look at risk shifting behavior of these banks. So we run a regression of changes in market leverage. So this is changes in debt divided by the market value of assets. And we run that against changes in asset volatility. And both of these are computed from the Merton model, with the idea is that if there's some sort of an outside discipline, asset volatility goes up, there should be some outside pressure on banks to increase their capital ratios, lower their leverage. And you do find that effect. So there's a negative relationship. Higher the asset volatility, lower the leverage. But again, this relationship breaks down for very large banks. We also look at the fair value of deposit insurance. So this is the fair value of a guarantee of all the liabilities of a bank. So this is based on the Merton's 1977 paper. He shows that the fair value of deposit insurance should increase with leverage and asset volatility. Okay. And since leverage is also going to depend on asset volatility, when you run it against asset volatility, you're essentially capturing two different effects. So the idea is that if you can increase the value of this guarantee, okay, holding the premium that you pay constant, then you're essentially shifting risk onto taxpayers or debt holders. Okay? And that's sort of what we find here. So on average, it's positive, and it's much stronger for the very large financial institutions. And again, we do the same thing as we did before, using large corporates as controls, and sort of find similar results. Okay, so and also in the paper, we do a number of things to address endogeneity. So most of the paper is about robustness around these main results that I have just outlined. So the biggest endogeneity concern is that there could be a relationship between size and spread that we're not capturing. And the most obvious channel is through risk. Okay, so the spreads of larger banks could be lower because they're more diversified, they might have much better access to liquidity during a crisis and so on. That's why their spreads are lower. And we show that that's not necessarily the case. So now we're going to put risk on the left-hand side and then run it against our measures of size, again, using corporates as controls. And although there's a positive relation between size and lower risk, it sort of breaks down again for the largest financial institutions. And compared to corporates, it's actually negative. And you can see that from the graph I already showed you guys. I mean, there's no clear relation between size and risk. We also use Fitch ratings as an exogenous measure of risk and implicit support. So Fitch assigns two types of ratings. One is an issuer rating, the regular rating that we're all familiar with, and a standalone rating, which exclude any government support. So when we want to spread against the Fitch ratings, what we find is that both are priced, okay? But it's really the issuer rating that's driving the pricing. So if you put both of them in the same regression, the issuer rating dominates the standalone rating. So it appears that it's really the government support that's embedded in the Fitch ratings that's being priced. So if you put rating on the left-hand side, run it against size, again, we find a similar relationship. If you're a large bank, that seems to increase government support implied by these Fitch ratings. Okay. Let me quickly go through this and then I'll conclude. So one other thing, robustness thing we do is look at shocks to investors' expectations. So we look at some key events that might have provided shocks to investors' expectations of government support. So if you think about Bear Stearns, for instance, that might have reinforced market perception of government support. Lehman, on the other hand, would have reduced it. So we look at we do a standard event study over a 10-day trading window. We'll compare large banks to small banks before and after the event. And we look at the risk sensitivity of large banks versus small banks, again, before and after the event. We also use corporates. So large banks minus small banks, large corporates minus small corporates. Again, the difference between the two before and after the event. So there are a lot of interaction terms here. And then the same thing with risk sensitivity. So let's look at Bear Stearns. So after this event, we see a very big decline in spreads of large banks. And it's both economically and statistically significant. We're looking at about 100 basis points decline. And we also see a big decline in risk sensitivity as well. Once we control for corporates, again, we find similar results. So if you look at the passage of TARP, again, very large numbers, about 100 basis points decline. Lehman, on the other hand, you see a big, you see the exact opposite. You see about 100 basis point increase, as well as a big increase in risk sensitivity. So we also look at the passage of Dodd-Frank and some information that was revealed about the FDIC's SPOE program. We do find some results, but they're not economically significant. Dodd-Frank actually goes the wrong way, but it's only a couple basis points. We also looked at Dodd-Frank over a longer time period, 6-month window. And again, we find that it was not successful in terms of eliminating these too big to fail expectations. We do a number of other robustness checks. One thing that we do, which is sort of very interesting, and you can read this in the paper, is we exploit this FDIC program that was put in place during the crisis. So bonds of certain financial institutions were explicitly guaranteed by the FDIC. So we can use this program and look at within firm variation, compare the explicitly guaranteed bonds of a bank with an implicitly guaranteed bonds and see how that difference varies over time. Since I don't have a whole lot of time, let me skip through that. And so the final thing we do is we quantify the subsidy, and this is what it looks like over time. On average, about 20 to 30 basis points, and there's a big increase during the crisis to over 100 basis points. And these numbers are actually consistent with some others have found, looking at different markets. For instance, there has been a study done by two folks at the FDIC. They're looking at deposit rates, not bond spreads, but they also find similar numbers. Okay, so with that, since I'm way over, I'll conclude. Thank you.
Okay, thank you. That's a great lead-in to Randy's paper. And of course, Randy, as you know, served on the Board of Governors when all this stuff was being decided and debated and dealt with. So Randy had a significant voice in the regulation, the measurements.
So how do I make this go to the next one?
Oh, okay.
And as this well illustrates for anyone who understands how the board works, the governors can't do anything without the staff. So, and this is a good illustration of that here. So I wanted to think about, in this paper, what I'm trying to do is do an assessment of, well, we've already talked about too big to fail, so I'll just skip over that. There's a large body of research that is trying to look at this, trying to measure too big to fail, and one way to do that is to try to see if there's some sort of difference in funding costs between large banks and small banks. And there have been a lot of different approaches taken to this, and so what I wanted to do here is try to see, well, what do we learn from the existing literature? What are some of the challenges that are there? What are some of the most promising methods for measurement going forward? And then think about, I just do a very simple natural experiment here with the FDIC coverage. As Deniz had mentioned, there's a lot of interesting stuff. You could call it interesting stuff. You could call it good or bad stuff, however you want to look at it. But there's a lot of variation in FDIC coverage over this time period. And so there may be sort of natural experiments that one can look at to try to suss out a little bit more information about the role of guarantees, the role of government support. So I think there's a lot of interesting stuff to be done. So what I try to do is say, okay, we've got an awful lot of literature, literally dozens of papers. Let's try to simplify that by putting it into just a few different categories here. So, and it turned out I was writing this paper at the same time that Ron Feldman and others were putting on a conference at the Minneapolis Fed. Unfortunately, I had a conflict and couldn't go to that conference, but my paper was structured almost exactly the same way that the Minneapolis Fed conference was structured. So I took some, I was heartened by that they put things roughly into these kinds of categories, thinking about, do you focus on bond and CDS spreads? Do you focus on credit ratings? Do you focus on deposits, equity prices, and other things? Just one thing that I wanted to mention here is that the way that I'm focusing on this, and George is very good about bringing up different definitions, so it's some form of size mattering. So it's the perception of greater government support for one class of institutions versus another. It's not just that there may be support for the financial sector generally. So one of my colleagues, Brian Kelly, and co-authors have some work on that. And I think it's interesting to think about that in the background, because of course the Federal Reserve was created out of in response to the panic of 1907, when the private clearinghouse system did not provide the appropriate lender of last resort function, and so it had that panic during that time period. And so in the background there's sort of this broader question of the one that Brian and others look at, just more generally in the financial services sector, does there seem to be some missing tail risk? That is, that there seems to be some support that might come from the government. In some sense, if they found nothing on that, that would mean that the Federal Reserve is not doing its job, because it was created to provide some lender of last resort function. The question I think that there's a lot of focus on is sort of one type of institution versus another, exactly as George had described. But I just want to make that clear that just a general finding of some sort of support for the industry, maybe people don't like that, or maybe people think that there are problems with that, but that's in some sense explicitly what the Federal Reserve Act has for and certainly with the amendments in the 1930s, for the Fed to be able to act as a lender of last resort and to take out some extreme tail risk in the financial services sector. I purposely said, because I think that may be somewhat, I think that's true, but it may be somewhat controversial, and I'd like to get people's opinions on that when we get to the Q&A period. So what I try to do is look at some general challenges for all of these kinds of approaches, and then get a bit more specific on three of the approaches: identification strategy, time period, sample, and some differences between large and small financial institutions. So first, on the identification strategy. So this is one of the biggest challenges because we want to use size because it's about too big to fail or something related to that. But there's a whole bunch of other stuff that's related to size that's very hard to suss out. A lot of Deniz's paper, which I think is a very, very good paper, is really trying to work on that. So you have this sort of the top 10%, and then try to think about robustness. Well, are we getting at something that's really related to the too big to fail piece, rather than just something related to size? And that's something that I think is a big challenge. Some of the work that Loretta and Joe have done suggests that there may be economies of scale that go up to the very largest firms. So one has to think about that. If there's some sort of scale economy that might exist even to trillion-dollar institutions, that may be a challenge to take into account. Another way to think about it, and Deniz's paper is taking steps in this direction, is to think about, well, what's the relevant comparison? Is it just big versus small banks, or do we see these kinds of differentials even when we look at big and small non-financials? It just is a very quick way of doing that. This is having no controls for risk. So this has to be taken with an enormous grain of salt. But if you just look at first order, just what things look like, just to very simple ocular econometrics, you see that there's a big versus small funding differential in general. Now that may come from scale economies, it may come from better diversification, it may come from a variety of things. But you see, before you do any risk adjustments, and obviously to draw any conclusions, you have to do that. Banks don't sort of stick out too much on that score. It seems to be quite widespread. One way of doing it formally is to try to do a difference in difference type of approach, where you formally take into account, say, well, we do the best we can to sort of do the risk adjustments and do liquidity adjustments, as I'll talk about with the bond and CDS markets. There are enormous nonlinear differences in liquidity. Actually, one of the things that came through during the crisis, as Loretta mentioned, is to realize how reasonably liquid markets could suddenly become illiquid, but also just how illiquid most markets are. We tend to think of most markets as being like the equity market, and very few markets are like the equity market. I mean, no markets are like that. They're the outlier, not the benchmark. Most bond markets are really very liquid, very little trading, and even for some of the largest firms, very little trading of even the large bank bonds. That's also true for CDS. There are only a very small number of institutions that have anything approaching somewhat liquid CDS market, which from a research point of view is a shame because there's potentially a lot of information and a lot of things that would be controlled for in looking at CDS. And I'll look a little bit at that in just a minute. And so I just described how things work in a difference approach. And so you might be more comfortable that after you take out these other things, because there's a lot that's unexplained in terms of just big institutions in general seeming to get some favorable funding. If we take out some of those factors that may be common to financials and non-financials, we might be more comfortable that this is about too big to fail rather than just some sort of advantages associated with size. Also, what's interesting in a lot of these studies is that if you look at the biggest institution versus the next biggest and versus a group of institutions that really aren't all that big, you still get some fairly sizable differences. So even if you do, in some sense, a difference within the banking sector, you're still seeing significant advantages for firms that we wouldn't normally consider as being too big to fail. Or, I mean, as George said, it might go down fairly far in the hierarchy, and sometimes it does. But at least in terms of the political debate and the regulatory debate, it's really the systemically important banks, the ones that are above $500 billion. But it's interesting that when you look even within banking, you still see significant advantages of the reasonably sized banks, like 100 billion relative to 10 billion, et cetera. So it's also something to take into account that there may be something else going on besides just too big to fail, or at least from the public policy point of view, if the focus is just on the largest institutions, that may not be the right way to think about it, given where the data are. time period. I think this is very important, and Deniz's chart really emphasized this. The perceptions of government support can change over time and change with regulatory regime. And in particular, you saw that the advantages that they had estimated were on the order of 20 or 30 basis points prior to the crisis, zooming up tremendously in the crisis, and they're starting to come down tremendously. And so I'd love to see an update of that work going through 2012 and obviously 2013 when the data become available, because we passed Dodd-Frank in just a few years ago, and some progress is being made. Some people argue that there's no progress being made. I think there is progress that is being made. I thought it was interesting in the event study that Deniz had, that there seemed to be some reaction to the white paper that was put out by the Bank of England and the FDIC, suggesting that the markets were thinking that there might be some, there is some progress there. If you look at the credit rating agencies, they have put all the uplifted ratings that Deniz had talked about on negative watch. That is, all the credit rating agencies say that they think that it's less likely now, or that, or I shouldn't say it's less likely, that they think that they put these on negative watch because they think progress is being made, and it may be enough at some point to actually eliminate or reduce those with support ratings. Moody's has actually gone further, and last fall actually eliminated them for bank holding companies. They said enough progress has been made for that. So there has been some change over time. I think what's interesting to look at, and this is just simple CDS for the largest banks. I said it's hard to get a lot of many banks in this, and I would like to. It would be great to have more banks involved. But you can see basically before the crisis, there's either a perception of complete too big to fail, or a perception of no risk. We can't tell the difference before because it's basically assuming that there'd be no losses associated with the senior debt of these major institutions. Once the crisis hits, they blow out, and they also differentiate. I think that's something that's very important to think about, because it seems like the markets are thinking, well, it's not just all or nothing, that sort of the biggest firms get bailed out and no one else does. There does seem to be some risk differentiation between these, and it varies over time. This is when the euro crisis heats up, and so and it seemed, well, I'm not going to say exactly what those are related to. Anecdotally, it's related to some of the exposures in Europe. So it seems to be showing some risk sensitivity that wasn't there before. This doesn't prove that there's no too big to fail issue, but it raises a question about, because some people have said, well, it's grown dramatically worse since the interventions during the crisis, and I think this is at least suggestive that people are thinking that there is more risk associated with these institutions. I can't specifically attribute that to or the liquidation authority or anything like that, but it does suggest that the markets are perceiving these as differentially and have differential risk and more risk than they had before. So the comparison group, this is one of the big challenges of, do you just look at the $4 trillion banks or the 6 or 8 banks that are the G-SIBs? That is nice and clean, but of course it's a small numbers issue. And the broader that you start to, when you start to broaden what is big, then it starts to raise questions about, well, how does this relate to the policy debate on too big to fail, which seems to focus very narrowly on 6 or 8 institutions in the U.S. and not more broadly on large financial institutions. And so, you can, there's no right answer for doing this. I think you have to sort of look at robustness and then think about, when you're drawing policy conclusions, you have to think about what sample did you use to sort of relate those to the policies. Because obviously, more data is better unless it introduces more heterogeneity. And that's the trade-off that comes in. Are you introducing institutions that may be large but don't, or are non-bank institutions that don't really have what, at least from policymakers' point of view, typically think of as being related to too big to fail? Do you include foreign institutions or not? Again, that's I would suggest no, because they're very different legal regimes that are behind them. I think it's cleaner to focus on the banks themselves for the particular policy debate that we're engaged in. But you can see that there are very few organizations here. And when you get to Bank of New York and Mellon and State Street, it's very hard to even get CDS trading on those organizations. They don't have as much debt outstanding as some of the others. And so there just aren't that, unfortunately, there aren't that many institutions to look at. So that's all this stuff has to be taken with a grain of salt. Also, there's a very big difference in the way these guys fund themselves. Small banks rely much more on deposits. Big banks rely on issuing debt securities. That's generally true for large firms can go to the debt markets. Smaller firms can't go to the debt markets. And also, one has to be careful in applying an estimate from one particular part of the funding structure, debt or deposits or one of the other pieces, to the whole structure, because there could be differences across them. And so this just gives you a little bit of feeling for the dramatic difference for like domestic interest-bearing deposits for the largest banks, the G-SIBs, about 30% of the funding, whereas it's more than double that for other banks. And what's interesting, although again you can't draw a particular policy conclusion from this, when you look at all the different pieces and put them together, because deposits from at least an interest expense point of view are much cheaper than than issuing debt. The actual average funding costs over this time period, over like the last 5 years, including the crisis, really aren't dramatically. Well, actually, they start off a bit with a bit of a differential, but then basically go down to something close to zero. So the specific approaches. So I think the credit rating approaches are very problematic because not only are obviously they're changing over time, but I think the markets just broadly don't seem to price the debt at what the credit ratings have as the so-called with support ratings. So this, although I think this is hard to understand, what this is trying to compare the CDS spreads for the largest banks with the CDS spreads of other institutions that have the same credit rating. And so you can look at that, so you can compare with their standalone credit rating or the with support credit rating. And so if you look in this period, the first half of 2012, you see that the CDS spreads for the banks, the median there, or similar for average, is much greater than either the standalone or the with support CDS. Part of that is because what happens is that the credit rating agencies in the middle of the year downgrade the large banks. You could either say that the credit rating agencies weren't very well informed, or you could say that the markets were well informed that the downgrade was coming. So here you get sort of more of an alignment of the market expectations and the credit ratings. But even here, in the second half of 2012, after the downgrades come, the median bank CDS is very close to the standalone CDS. It's not close to the with support CDS of other institutions that have the same credit ratings. So it doesn't seem like the markets are really pricing at the standalone rating. And all of the work that uses the credit rating implicitly assumes that or very explicitly assumes that the markets are pricing at this. This is an actual advantage that they have in their funding. And I think the evidence, at least in the recent period, is that that's not there. And so I would think this is not a very promising approach. The deposit method, very difficult to get apples to apples comparisons because there are a lot of implicit services that come with deposits. And the FDIC study that Deniz mentioned, which I think is probably the best, one of the best in this, there's still some challenges there. So another way to go about it is perhaps think about some of these natural experiments. So one that I thought about was that we had this temporary the temporary transaction guarantee program, the TAG program, that said, okay, we're temporarily going to provide complete deposit insurance for a certain type of bank account, transactions deposits, which tend to be very large payroll accounts and such, and they're actually a significant fraction of the funding. If you look back at banks here, the non-interest-bearing deposits, so that's what we're looking at, the tag deposits, the non-interest-bearing deposits, it's 18% of both the big and the small banks. So this is a significant chunk of the deposits. Well, what we had is that we temporarily made those all FDIC insured, so no risk difference between big and small banks or between any institutions. But then we eventually eliminated that at the end of 2012. After a lot of consternation, that a number of the small banks were very concerned that that the deposits would flow out. But actually what we see is virtually no deposit inflow to the big banks, because you would think if you suddenly take away this insurance, it's now everything just has $250,000 insurance. These tend to be very large deposits over that limit. You would see a flow into the institutions that are implicitly insured, and the outflow from the ones that no longer have the explicit insurance. We actually don't see that at all. What we see is actually a bit of a flow into the smallest banks. So, so this is looking for the end of the quarter so looking at the two change in non-interest-bearing deposits, end of quarter of 13. That's the wrong end of quarter. Oh no, that's right. End of quarter of 12. So it's one quarter, the last quarter of 12, to the end of the first quarter of 13. I also looked at whether it's so not just the tag deposits, but also deposits in general, because perhaps some of these deposits were changing form. You get the same result. You can look over a 6-month horizon rather than a 3-month horizon. You get the same result. And so what this would suggest is that markets, or at least the people who are the large depositors, didn't perceive a risk difference, because these have zero interest associated with them, so there's no interest differential, and there's no deposit outflow from the big banks to small banks. So it's at least suggestive that, at least in this period of 2012 to 2013, that those depositors didn't perceive a big difference in risk between the two types of deposits.
Randy, you're going to need to finish up.
And I already mentioned the difference approach, big differences in liquidity, and so this is a very important set of policy issues, and I'm very glad that people like Brown and Vitter have, from very different sides of the aisle, have asked the GAO to do basically cost-benefit study to try to get data on this, because I think it's very important to try to do substantive economic analysis of this, some specific challenges. But this doesn't mean that we can't do anything. I think the difference approach and some natural experiments approach are very helpful going forward. And at least this one particular one that I had looked at the end of the TAG program suggests that at least in the 2012 to 2013 period, that the large the depositors in these transactions accounts didn't perceive very large risk differences between the biggest banks and other banks.
Thanks, Randy. And our final speaker, last but not least, of course, is Ron Feldman. And of course, he also was on the front lines during the crisis. We can blame you for this, right?
Certainly not. I think Randy was agreeing to take all the blame associated with the crisis. So I've learned a lot. First of all, thanks, Jalop and other of the organizers for having me here. I've learned quite a bit. I now know if I work at the Cleveland Fed, I'm Ron, I better come on time to meetings, and if I'm given 20 minutes, I better conclude in 20 minutes, because that's what my boss wants me to do. These comments are motivated by three things. So first, Randy mentioned a conference that we had, which essentially looked at the papers associated with calculating the subsidy associated with too big to fail. And Andy Atkinson, I think maybe some of you know, he's at UCLA, he used to be at the Minneapolis Fed. When he was summarizing this literature, he said he thought the subsidy results were disappointingly small. So what does he mean? That's an odd comment for an economist, right? There's not a lot of economists I've met in my career at the Fed who said, boy, that subsidy is too small. We ought to get that subsidy up higher. So what did he mean? I think what he meant was for folks, I don't think just at Minneapolis, who were thinking about moral hazard as being an important component for why you're worried about too big to fail, to see subsidy estimates that are close to zero before the crisis is going to cause you to rethink why you think this is an important issue. The second point is closely related. So we've been looking at these subsidy estimates since they've been coming out for quite some time, and our president, Narayana Kocherlakota, was going to give a talk, and he was going to show graphs basically showing what those subsidy estimates look like. And I was working with him on a speech, and he said, boy, I'm really surprised you're willing to put these graphs out in the public domain. So why is that? Well, you did some stuff with Gary Stern, the former president, and this shows that you guys were completely wrong. So that's That's very big of you to agree to have those out there. And then the final reason I'm going to make these remarks is because I was going to talk about the subsidy estimates, and then I saw that Randy was going to be on the panel, and I'd already done a good summary of it, so I was forced to come up with something else. And so what I'm going to talk about is whether or not these rationales that many people had for thinking about trying to quote unquote fix the too big to fail problem, which in my experience were all related to moral hazard, and maybe there were some other comments, but were those right? And really, were those relevant? Are those relevant for the kinds of reforms that people are thinking about to address the problem? And I'll be on time. So let me and I'm going to think maybe not. Maybe they weren't right, and maybe they're. But even if they're not right, maybe they're not relevant for thinking about what motivates you to try to take reforms to address the too big to fail problem. So I've got a disclaimer, expressing my views. I also have a second disclaimer. So I'm out disclaiming the other people at this panel so far. And any of you who come after, you can't put a third disclaimer in to try to beat me. These conclusions only recently came to me. I have a thought that for many people, particularly when I knew Franklin Allen had published quite a bit. When I heard how many articles, I'm sure these thoughts have come to him a long time ago and other people, but they're new to me, so I apologize if they're just obvious. So I'm going to make 3 points. So first, I'm going to assert, these are essentially all assertions, just by the way. There's not going to be any, if you're worried about not being able to read anything, you're going to be okay, because there's not going to be any formulas. In my experience, moral hazard concerns what motivated, before the crisis, this is what motivated people to try to suggest that we ought to do something about too big to fail. That the subsidy estimates, if you take them seriously, since the moral hazard problem is typically associated with reduced funding costs for larger banks below what they would be otherwise, I think if you're going to take them seriously, they call that motivation into question. And nonetheless, I would say virtually all of the reforms that people were talking about before the crisis, I think are justified. So even if you don't think moral hazards are important, I think the crisis experience suggests they're important. So let me proceed. So, Bill had said he had a shameless plug to some prior work. I guess almost all of this is shameless references to prior work. So the year is going to be 2004. Gary and I wrote a book called this book right here. And what was the motivation for writing this book? It says The Hazards of Bank Bailouts. You can still buy this, by the way, on Amazon if you're curious. So that we had some talking points, and so what was the motivation? So the motivation was that this problem's not getting solved, it's getting worse, and it leads on balance to wasted resources, right? I think that's the important part I want to focus on here. So what did we mean by wasted resources? I'm not going to read it. The bottom line is we said that because creditors anticipate they're going to be protected, they don't price the liabilities correctly. Therefore, firms don't get the right market signals, and they take on too much risk. Because they take on too much risk, it's suboptimal use of resources. My experience was that this, at the time, I'm sure someone will come up afterwards, and you should be better if you did it afterwards and not in front of me, but my experience was this was the rationale that people gave for wanting to address too big to fail before the crisis. I'm not really aware of other people who had other motivations other than a moral hazard related sort of view of it. And for some people, even in 2013, this is a speech that Narayana Kocherlakota gave in Minneapolis. I'm recognizing that this might just be a Minneapolis thing, and I'm now leaving Minneapolis, and maybe that's what I'm discovering, is that people think differently outside of the Minneapolis Fed. But here Narayana is defining what the too big to problem is, and he gives the exact same motivation for why he's thinking about it. He's talking about... What?
Did you write the speech for him?
That's true. Maybe that's the common factor. No, I think people who know Narayana doesn't need my help. Neither did Gary in writing speeches, although sometimes they asked anyway. So that's the motivation. So what were the reforms that in this book? What did we say you ought to do? Because again, the motivation was moral hazard. What was our rationale? What was our reforms that we suggested? Well, we said there's some, and I'll also just say this is cherry picking. There's a lot of reforms when I go back and look at the book that are really look stupid in retrospect. These are the ones that I think look better in retrospect, so I'm going to pick those. So we said you ought to do something that we called supervisory stress testing. So you want to look at the financial system, think about what kind of shocks you want to have, and see which firms are going to survive or not. We thought that you ought to try to come up with a new system. We called it, based on work that George and other people had done, structured early intervention and resolution, that you ought to enhance that kind of effort. We thought that we called rapid recapitalization. At the time, we were thinking about COCOs, but I think those are really similar to sort of the bail-in debt that people are talking about now. We also thought there was ways of reducing the cost of failure. We thought that you ought to do supervisory contingency planning, which we said you ought to think about in advance what would happen if a large firm failed, what steps would you take today, maybe to even alter the structure of the firm. And we said that multinational bank failures were very problematic and you needed to think seriously about how you were going to try to resolve one of these firms. So these were some of our suggested reforms. We also made, so those of you who know, in the 10 commandments, there's positive commandments and there's negative commandments, right? Do these things, don't do these other things. So I'm not comparing the work to the 10 commandments, but I'll just say we had a similar work. Yeah, those have lasted thousands of years, and I think we stopped getting sales after about a couple of years. So there's a difference right there.
I'll call you Moses Feldman.
That you could, well, that wouldn't be too far from the real name. So what did we say? We said, yeah, supervision you shouldn't rely on too heavily. We said just making no bailout pledges, constructive ambiguity, that's not going to work. And the process that George alluded to in fiducia, which I won't go through because of time. But if you create a very convoluted process and you think that's going to prevent people from bailing people out, that's not going to work either. Okay, so that's basically just to set the stage that, and again, our experience was people who were concerned about moral hazard were people who said before the crisis we should do something about too big to fail. Generally speaking, in my experience, people who said there was not a moral hazard problem generally thought there was not a too big to fail problem, or that there was nothing you could do about it. So let's look at these subsidy estimates. I'll be quick here. I only really have one graph. So if you look across all of these studies, Deniz's study and a variety of other analysis, both in Europe and the United States, it looks like this. This is before the financial crisis. It's low, sometimes it's zero, but it's always low. During the financial crisis, it's high, and post, it's come down, but it's not all the way back. You don't need to read the papers now. This is what they're going. Deniz made a point that they're very consistent in the size. They're very consistent in this pattern. This is what virtually all the papers find. So let's say you take that seriously, and so Randy's written a summary that I think is could be read as being skeptical about how seriously should you take these things, as well as suggesting future work. But let's say you take them as correct. Well, if the funding distortion was basically zero, it was close to zero. Maybe it was 20 basis points, maybe it was 5 basis points, but it was very small. So if you're going to make an argument that funding distortions were what you were worried about, it seems like it's hard, because these are looking at a lot of different ways of saying that there was really not much of a funding distortion due to size. And that's not consistent with our rationale, as well as I think most other people's rationale. Okay, so I guess I could stop there and say that was a big mistake, and maybe I retract my earlier suggestion that you buy the book, but actually you should still buy it, because I'm going to argue very briefly, and leave some time for questions, that the experience we had during the crisis suggests that these same reforms are still worth doing, even if you don't buy original rationale. So another lesson from the crisis, which again, I think this one clearly was well known, but I think it's been really reinforced, was that if you have a large firm, a large financial institution, it fails, there can be a lot of externalities. And there's no reason for thinking that the managers or equity holders are going to take into account the cost of their failure, because at the time of the failure, they're not going to have, their equity stake is gone, they're going to get fired, so they're not going to worry about it. That's going to be imposed on someone else. So they don't internalize these costs. So governments is a classic externality problem. Government policy should force firms to internalize the costs. So how would they do that? How would governments force the firms to internalize this externality that's associated when they get in trouble, that other firms get in trouble, and the real economy slows down? Well, you would do all of just if you weren't tracking this presentation closely, this is the same slide that I had before. These are the same exact suggestions. And in fact, virtually all of the major reform proposals, not all of them, but I just listed what the current reform proposals are. I should be clear, our description of these are not precisely what was implemented in Dodd-Frank, but they're of the same gist. So what is that? What do I take away from that? I take away that that the original rationale that many people had doesn't, it, in some sense, isn't relevant because there was another rationale that moved us forward. I want to make one comment here. I've sort of said we have to take this. So I think, again, not to put words in Randy's mouth, but the gist of the paper is, boy, when you look at these empirical methods, there's some reason for being cautious. If you agree that there's this externality and that the government ought to do something about it, it doesn't get you out of the measurement business, right? Because you have to figure out, if you want to say I'm going to impose higher capital requirements because I want the firms to internalize this externality, well, then you need to have some sense of how much are you going to do that if you're going to do all these things. So measurement's never, you can't escape it. And I would also say, while I appreciate many of the comments that Randy makes in his paper, I do wonder whether they could be applicable to virtually all the empirical work that policymakers have to rely on, which is, generally speaking, quite imperfect, but people have to make decisions. That's not justifying the intentional use of imperfect measures, but where people have to make decisions, sometimes that's really the best you have. So, additional work is worthwhile. So I thought I would have just one concluding slide. This is just saying that the other list, I think the crisis, just as an FYI, I don't think, despite the fact that I run a supervision department, I don't think supervision came out of the crisis looking particularly well, or any of these other things that people said were going to work. So just some final thoughts. So the whole comments to date have been conditioned on that we ought to take these subsidy estimates seriously, and that they suggest that there's really no moral hazard concern. I'm not sure I actually believe that, but I thought it was useful to do the presentation. But let me just make a couple of thoughts that maybe run the other way. So one is, even if there was no funding differential before the crisis, there was one during the crisis. I think that's there. And if you're worried about gambling for resurrection or any of those sorts of things, then I think you should be concerned about the fact that they were relatively high during the crisis. The second is, I've talked about moral hazard associated with funding, but of course there might be other things that don't get picked, that intentionally are not picked up during these measures are designed to look at funding, but moral hazard could have other implications. So maybe collateral, maybe the way contracts are written, et cetera. I know those are very hard to tease out, but there might be something there. And then finally, my own sense is that actually every time I've seen Deniz's papers, I think a couple of times now, and read it a couple of times, and it gets better with every iteration. He said it's now 80 pages, so I understand why that is, because he's responding to all the comments. But I think there's, even at the current stage, I think there's improvement ahead for these subsidy estimates. This is a really hard thing to measure before a crisis, because you're really looking at sort of tail risks and how they're being priced by markets. But I know, with efforts between Philly Fed and Wharton and other things, I think we're bringing people together to focus on this issue. It's true there's some papers. Deniz described the literature as large. I guess I would describe the literature as relatively small relative to other areas which I think have not received as much attention as trying to figure out how these should be. So I do wonder in the future if we're going to go back and look at this and say maybe there was something that was there. So with that, I'll turn it back over to Loretta.
Thank you very much. So I know there's going to be lots of questions in this session, I suspect, and rather than me talk, I will open it up for questions. It'd be great if the organizers have asked that if you want to ask a question, you give your name, affiliation, and I think there is a microphone running around the room somewhere. So put your hand up high and...
Pavel Kepinas, FDIC. I have a question for Professor Kroszner. How natural are these FDIC-driven natural experiments? Because there was a change in deposit insurance from 100,000 to 50. This change with non-interest-bearing account guarantees presumably happened because policymakers felt comfortable enough about phasing it out. So what does that mean for your results, this concern? Thanks.
Do you want to gather a few questions, or do you want me to?
No, you can go ahead.
That's an important point, because obviously the experiments only are natural if the variation is exogenous. And there had been a debate in the fall of 2012 of whether this needed to be extended once again, because it was extended once prior to that. because there was a concern that there'd be these outflows, and a number of the small banks did make an effort, a political effort, to try to have this delayed further. As you said, the politicians decided there wasn't sufficient evidence of concern, and so let it happen. So it could be that it was something that's endogenous, that only because everybody knew that it wouldn't make any difference that they did it. But I think, given that there had been some statements, I think in the paper I have one or two statements by some of the small banking groups saying how difficult this is going to be for them, there was some concern, maybe not as much of a concern as before. And so I wouldn't want to hang my hat just on this one. I think that is it's one interesting thing to do. I think, Deniz, you've looked at the temporary liquidity guarantee program, which I think is another interesting thing to do, where you have guaranteed and non-guaranteed debt from the same organization. I think it's harder to do the 100 to 250,000 because that's sort of in the heat of the crisis. That really seems to be very much endogenous because there's something else that's going on. And so, but I mean, I think even if you were to look over a longer period of time, at least subsequent, I guess I should look at this more carefully. I don't think you saw a large dripping out of those deposits from the small banks to the large banks. There may have been some, well, in the heat of crisis, I'm not quite sure what was going on. But I think if you look over a longer time period, I think you see something similar. So has to be taken with a grain of salt. You have to assess the naturalness of the experiment, but I think it's at least suggestive. Luke.
Okay, Haluk Günal. Well, I mean, it's interesting that both Deniz and Randy is kind of alluding to that we should look at the bond spreads for too big to fail to observe the action there, because the literature, majority of them looked at the equity return. So it is, and then Ron was saying that we should look at the funding cost and so on. I just want to point out a paper published about 10 years ago in JFE, and which is kind of identification and your natural experiment, which looked at the issuance cost before mergers and after mergers, and then looked at, how the medium-sized banks versus large banks versus small banks. And you see that in that paper, only the medium-sized banks who moved to the too big to fail threshold saw reduction in their funding cost, debt cost, and that we don't see that in small and in the large banks. So really looking at the M&As is really getting at your identification and your natural experiment and looking at the funding cost that Ron was talking about. Thanks.
Unfortunately, in the more recent period, because now the largest banks have gotten to the roughly at the deposit limit or above the deposit limit, you can't have mergers for those. So it would be great to be able to do something like this in the more recent period, but because of the laws, we're not going to be able to observe that.
Yeah, and
Sorry.
the reason that there has been a lot of discussion of bond spreads as opposed to equity returns is that, as I mentioned, it's really mostly the debt holders that sort of suffer. But one point that Daryl Duffy brought up in the Minnesota meetings is that if you're looking at corporate bonds, they're going to be the first ones to get hit in the capital structure. So in a way, you're underestimating some of the effects.
Okay. Hi, I'm Bob Chakravorty from the Clearinghouse. I had a couple of questions for Deniz. The first one is, I wondered if you had tried to separate out just the bank holding companies in your sample and see. I know you gave a reason why you want to include them. But if you look at that data, it seems like the non-bank holding companies are much higher. I mean, you named a couple, but if you look at the whole spectrum of the things, so that's sort of question number one. The second question has to do with sort of the time period, looking at going forward. I mean, we've worked with some people that have looked at sort of trace data and other things, and there are some lags. But if you were to look at it going forward, 2013, and would you expect that to decrease further, or what would your expectation be?
So on the first question, we did look at bank holding companies separately. You do see an impact. In fact, we did a cross-sectional analysis where if you interact the size 90 dummy with a bank dummy versus insurance brokers, dealers, and so on, the biggest effect you see is for the bank holding companies. On the second question, we actually extended the data to 2013, and some of the more recent event studies we did actually towards the end of 2013. It has come down. I think we have the numbers updated to 2012 now. It has come down, but it's still positive. If I remember correctly, it was about 20 basis points around that.
Well, I want to thank the panelists, and I hope that you enjoyed the session. There's a lot more to do on too big to fail and understanding it and sort of controlling incentives from both the regulators in terms of deciding what to do if a bank, big systemically important bank gets on the brink, and balancing the moral hazard problems against the risk of a crisis, and also on the part of the banks for taking on either because of contagion that they don't internalize or excessive social risk. So more work to be done, as we heard, and we have directions of how to go about it now. So thank you very much. And now I think we're adjourning for lunch, but I don't know exactly where lunch is. Okay. It's in the Eastern Court, which is on the ground floor.
I'd like the keyboard, because I got used to this when I went to the
Well, thank you for the ride.